As 2021 approaches with no slowing of the COVID-19 pandemic, AM Best is releasing its market segment outlooks on the major U.S. insurance segments and the global reinsurance industry. I'm John Weber for AM Best TV. Here to discuss them is Stefan Holzberger, AM Best Chief Rating Officer. And Stefan, the health insurance outlook is staying at stable for 2021, which for some could run counter to expectations. What's AM Best seeing to support that decision?
Thanks, John. Before we jump into the market segment outlook for the health sector, I just want to spend a quick moment and remind the audience that a market segment outlook is different than a rating outlook, right? So for the market segment outlook, we're really talking about the general health and conditions of the market, not so much the rating outlooks of the companies competing in that market. So you could, for example, have a negative market segment outlook, but that wouldn't by definition mean we're expecting negative rating actions on specific companies, because for those rating actions, it really depends on how the companies are reacting to those market conditions. So just an important point of clarification, market outlook versus a rating outlook. But to your point on the health sector, we do have a stable outlook, market segment outlook on the health sector, and that could be a bit counterintuitive, where, as we know, we're in a second wave of the pandemic. We're seeing an increase, unfortunately, in positive cases, an increase in hospitalizations, and certainly that's producing a good amount of strain on the health system, sadly. But when it comes to the financial health and the creditworthiness of the health insurance companies and just the general market that we're talking about that the health companies are competing in, we actually see this increased cost associated with COVID-19 being more than offset by the reduction in elective procedures in 2020 that we've seen under these pandemic conditions. So all in, from an earnings standpoint for the market, 2020 appears to be an extremely favorable year from a bottom line earnings standpoint. And a large part of that is due to this offset between the hospitalizations and those associated costs and the reduction in elective procedures. But I think it's also important to note that the health sector and the health insurance companies rated by AM Best have really come into 2020 from a position of strength. Year over year have been very favorable earnings, regulated earnings from their insurance businesses, but also fee-based income from the vertical integration that we've seen in this sector over several years. So it's not to say that this sector doesn't have the challenges. Certainly there are many challenges facing the health sector today, but we do feel from a capital, a liquidity standpoint, and as I mentioned, from an earnings standpoint, very importantly, the sector is well positioned to tackle those challenges for the remainder of this year and certainly into 2021.
Now, for global reinsurers, AM Best has maintained that the market positives and negatives are largely offsetting, and so the outlook has remained stable. Do you expect any of these positive or negative attributes to become more pronounced next year?
Yeah, so for the global reinsurance sector, we do see some very positive momentum, and that has enabled us, despite these difficult conditions, to put a stable outlook on the global reinsurance market sector. And that's really driven by a favorable environment for rate increases and a tightening of terms and conditions that we saw coming into 2020. So after several years of soft market conditions where the reinsurance segment has really struggled to achieve its cost of capital, we saw in 2019 finally a real increase in rates, a tightening of terms and conditions that would translate into bottom line profitability for the sector. And we expect that, to your question, we expect that to continue into 2021. Clearly, the macro level conditions will have an effect on the reinsurance sector. The low interest rate environment means that these organizations need to achieve their underwriting profitability in order to have a reasonable return on their equity on a risk-adjusted return basis. So these organizations need to rely on their underwriting profitability in this low rate environment. You have some other factors that we feel at AM Best will help sustain this positive momentum. For example, alternative capital has really pulled back after they've experienced loss creep and trapped capital during several years of heightened catastrophe activity. So couple that with a reduction in capacity on the retro side, we really do feel there's an impetus for prolonged favorable rate environment, which is really badly needed for the reinsurance sector. So it's really for those reasons we're maintaining a stable outlook. Again, a little bit like the health sector, despite some significant challenges posed by the pandemic and just the general economic market conditions.
So, Stefan, the commercial lines outlook is negative and personal lines is stable. What areas of the commercial sector are most worrying? And is there anything out there that could tip the personal lines outlook?
Yeah, so more so than certainly health and reinsurance, we do feel that the commercial lines P&C sector is highly correlated to the macroeconomic conditions. And a good example of that is the top line revenue for a commercial insurer is really in large part going to be dictated based on the earnings and revenues of the policyholders and the clients of these commercial insurers, where many lines of business really are driven, the revenues, the insurance revenues now are driven on receipts and growth of the businesses that are being insured. So you have pressure on the top line. It's very difficult to quickly adjust the expense ratio. So that aspect travels down to bottom line earnings, which will certainly be under pressure for many commercial lines of business. You also have the result of several years of soft market conditions for commercial P&C, whether it's professional lines, the poster child for weak rates and adverse reserve development being commercial auto. Some of these lines of business are really coming from a position of weakness. Unfortunately, they are seeing rate increases, badly needed rate increases, but it'll still take compounded rate increases year over year to get to the kind of rate adequacy that will produce the earnings and the returns that these commercial insurers need, right? So you do have some positive factors. Again, it's the level of capital supporting the business in the market is very strong. Liquidity remains strong really across the board. So there are some positive factors there, but really kind of where the rates are coming from and just kind of the general dark cloud from a macroeconomic standpoint has led us to maintain a negative outlook on the commercial sector. Speaking to personal lines, a little bit of a different story there. Personal lines are mostly mandatory covers, right? If you have an automobile, you need auto insurance. If you have a mortgage on your home, you need homeowners. The underlying rates for both auto and home are at a good level. With the remote working orders mandated under COVID-19, we saw a pronounced reduction in loss frequency on the auto side. So that's obviously been kind of a one-time temporary favorable aspect for that part of the personal lines market. There have been some premium givebacks to policyholders, but still a good environment from an earnings standpoint. And then on the homeowner side, very active year for catastrophes in 2020, but we saw these organizations make good use of their reinsurance protection. Could be a challenge going forward as reinsurance rates continue to rise and capacity shortfalls in certain areas of the U.S. Become more and more pronounced. But as things stand today, we do feel that from a rate adequacy, a risk management, as well as kind of leveraging technology and innovation, personal lines insurers are in a good position of strength to handle the challenges they'll face in 2021.
Now, I think it's pretty safe to say that the life annuity segment is affected more by the economy than the other sectors. What are you expecting for 2021?
Yeah, so for life and annuity, they're very much affected by the investment markets, by macro conditions, and by interest rates, right? So with this prolonged interest rate environment, we've been talking about spread compression for several years. that really doesn't seem to be going away anytime soon, and it's challenging the profitability of the life and annuity products, right? You also have the potential for asset impairments. The investment markets appear very healthy. There's ample liquidity in the market, which is a good thing, but I don't think we feel that the sector is really out of the woods yet when it comes to investment volatility, asset impairments, and what that can mean to the capital and surplus of life and annuity organizations, which, as I mentioned, have fairly high investment leverage. So, we feel that the sector is actually managing, the individual companies are managing these challenges. They're modifying products to account for the low rate environment and that spread compression. But there's just a huge amount of challenge and uncertainty for life and annuity insurers today, and hence the negative market segment outlook for that group of companies.
Overall, despite the specific outlook, Stefan, would you say that uncertainty is still casting a very large shadow over the industry?
Yeah, I think one of the themes for 2020, and that will carry into 2021, is uncertainty, right? We don't know whether we will see a second round of government stimulus. We're not, how the Fed will respond to challenges at the macro level. You've got issues around PRIA, right? The Pandemic Risk Insurance Act. There are competing programs that are being considered, but all in the idea of how do we protect the economy? How do we protect businesses from lost revenue associated with future pandemics, right? Huge amount of uncertainty in terms of whether we will even see some kind of federal backstop, which we at AM Best feel is really what's needed for long-term health of the economy and business and consumer confidence. Kind of speaking specifically to the insurance sector on that topic of uncertainty, what will the protections look like against COVID-19 related litigation, right? Whether it's litigation against businesses, schools, medical institutions, nursing homes, those decisions and the legislation around some sort of immunity will have huge implications for the insurance sector when it comes to indemnifying and the liability associated with those sorts of suits that could come through if that sort of protection is not enacted, and certain aspects of the economy and the communities are given some level of immunity so long as they're following the rules that would protect them against class action lawsuits, which of course would bring in the insurance companies as their insurer to protect them and possibly indemnify them against those lawsuits.
Thanks, Stefan.
Thank you, John.
As AM Best Chief Rating Officer Stefan Holzberger, and I'm John Weber for AM Best TV.